Have you ever seen a stock or a crypto coin price suddenly skyrocket, and you bought it immediately because you didn't want to miss out, only to watch the price crash later? It feels like a fluke, but it's actually a calculated move by big money investors. They need a crowd of people like you to buy at the highest price so that they can sell and walk away with the profit. In the industry, we call this exit liquidity, and if you don't know how to spot it, you're likely the one providing it. In this video, we are going to show you how to stop being the paycheck for big investors by breaking down how the pump and dump schemes actually work. Also, we'll dive into another major red flag every investor needs to recognize: the rug pull. Most people think they know these terms, but very few truly understand how they work, why they happen, and how to avoid becoming the next victim. If you've heard about these schemes before, sit tight as we break them down in the simplest way possible, so you can recognize the warning signs early and protect your money before it's too late. Remember, the ultimate goal of a smart trader is to protect their capital. Without your capital, you have nothing to trade or invest, no opportunity to grow, and no way to recover from losses. Preserving it ensures you stay in the game long enough to seize opportunities and grow your portfolio. Now, what is pump and dump? A pump and dump is a scheme in which a group of investors, often called smart money or insiders, artificially inflates the price of an asset, usually a stock or cryptocurrency, through hype, false news, or coordinated buying. The goal is to pump the price up so that unsuspecting retail traders jump in out of fear of missing out, FOMO. Once the price reaches the target, the insiders dump their holdings at the high price, leaving the retail traders with huge losses as the price crashes. For example, John wakes up one morning, opens his crypto exchange, and buys a random XYZ low-cap token. After buying, he goes on social media and starts hyping it, sometimes by collaborating with popular influencers who have thousands of followers. You begin to hear things like, "I told you about Bitcoin when it was $500, and those who bought then are sitting on massive profits today. Buy this now before the price explodes." Or, "I told you this influencer was going to launch a coin, and it happened. Those who bought early made huge gains. I started with $100 and now I have $1 million in my account. Buy now before the price jumps." As these posts continue to spread on social media, novice traders become emotionally driven and start investing in the token. As more people buy, the price continues to rise. The token begins trending on social media, and influencers continue fueling the hype. The next thing you hear is people saying, "I wish I had bought XYZ token when it was 10 cents. Now the price has jumped to $2. At this stage, influencers begin posting screenshots of their profits, claiming they made thousands because they bought early. Meanwhile, John sits in his room, monitoring the charts, waiting for the best time to strike. Now, this is where things get ugly. Once the price of the XYZ token reaches a certain level, let's say it moves from 10 cents to $4, John and his team sell all their tokens. This sudden flood of supply causes a sharp crash in the price. As the price of the XYZ token continues to fall, many of those who bought during the hype panic and sell their holdings to minimize their losses. In essence, the higher the price at which you bought the XYZ token, the bigger your potential loss. And your losses depend on three factors: the price you bought at, the amount you invested, and the token's price when you sold. For example, let's assume you bought $500 worth of the XYZ token at the $4 price point, then it crashed to 80 cents. Your portfolio would now be worth about $100, meaning you've lost roughly $400. In that moment you lost $400, you unknowingly became the exit liquidity for smart money traders like John and the other people who entered early, created the hype, and exited at the top. Exit liquidity is when new buyers provide the money that allows earlier, smarter investors to sell and get out of a trade. This is exactly how portfolios get wiped out, not overnight, but through repeated decisions driven by social media hype, emotion, and late entries into already pumped markets. That's how the pump and dump scheme works. Remember, sometimes it's not only people like John who trigger pump and dump schemes. In many cases, developers create tokens and pay influencers, either with cash or token allocations, to promote and pump up the price. Unsuspecting individuals then rush to accumulate these tokens, only to get burned later in the process. So, how do you recognize a pump and dump scheme? One of the ways to recognize a pump and dump scheme is that it targets cryptocurrencies with a low market cap and trading volume. If you are wondering what a market cap is, it is calculated by multiplying the current price of the crypto coin by the total number of coins in circulation. Tokens with low market cap are easier to manipulate because it doesn't take much money to push the price up quickly. So, if such a coin, which is relatively unknown, suddenly booms, you have to be cautious. Another way to identify a pump and dump scheme is if you notice a sharp increase in the price of a cryptocurrency within a short period without any clear reason such as news, innovation, updates, or partnerships. Combined with a low market cap, you have a clear picture of a potential pump and dump scheme, signaling that you need to be cautious. So, as a smart trader or investor, before entering any trade or investing, ask yourself a simple question. Why is this cryptocurrency price going up? Why is this stock price going up? If there is no major news to justify the price increase, there is a high possibility that the sudden spike is driven by hype rather than value. Another way to recognize pump and dump is aggressive promotion on social media with promises of the next big thing. Screenshots of profits and messages like, "Buy now before it's too late." The goal of these influencers is to create FOMO so that unsuspecting people like you rush in without thinking. If you are not careful, you will start thinking like, "I wish I had bought earlier," or "I don't want to miss out on this one." At that point, you'll notice that emotions have replaced logic, and you are likely to make decisions that put your money at serious risk. That's because all you are thinking about is how to cash out through the rally. Well, history has shown that you might end up becoming the exit liquidity of these smart money traders and investors. So, what is the lesson to learn here? Before buying, always check the price history. If you see a sudden spike followed by extreme volatility, and there's no solid fundamental reason behind it, treat it as a red flag. In many cases, what you're looking at is a pump and dump in action. Always have your own trading or investing strategy and stick to it. If you are unsure of the market, it is better to avoid it entirely and walk away with your capital than to gamble it, because opportunities will always come, but lost capital is much harder to recover. Now let's look at another common way people lose money. Rug pulls. The term rug pull comes from the idea of suddenly pulling a rug from under someone's feet. Everything looks fine at first. The product seems legit and the price is rising. Then, without warning, everything collapses and investors are left with losses. This is commonly associated with the crypto market. For instance, someone creates a new cryptocurrency, hype it on social media to attract investors. Then, when everybody is rushing to buy the crypto, the developer suddenly abandons the project, walking away with investors' money while the victims are left with worthless tokens. In simple terms, a rug pull is when a crypto project's creators suddenly exit with investors' funds, leaving the token worthless. Let's use the Squid Game token as an example. In October 2021, just a month after the popular Netflix Squid Game movie series was released, a group of individuals teamed up and launched a crypto game with the same name. Given that the movie series was making waves across social media, many people saw the Squid Game token as a legit crypto coin they could profit from. Now, this is when things got interesting. These scammers entice people with the promise of earning rewards in the form of play to earn when they buy the Squid Game token. And as we all know, people love free tokens they didn't have to work for, spend money on, or struggle to get, like an airdrop. So many people rushed to buy the token, thinking they could easily earn through the play to earn program. To make it more legit, these scammers came with the promise that earned tokens could be exchanged for cash, triggering more hype on social media. The Squid Game token became the talk of social media, with many investors flooding in. Given the principles of demand and supply, the Squid Game token surged by over 1,000% within a week. Those who didn't buy early began to regret, asking questions like, "I wish I had bought earlier." Emotional manipulations start to set in with screenshots of profits flying over social media like wildfire. But there's one thing they forgot to ask. Does this token actually have any connection to the popular Squid Game movie? As we said earlier, smart traders focus on research, while new amateur traders get carried away by hype and emotions. The truth was that the Squid Game token had no connection to the popular movie, but many didn't notice it, perhaps because of the hype surrounding the token. By October 29, 2021, the Squid Game token had surged by over 500%, with many investors celebrating their big wins. Some were already planning vacations and other things to do with the funds. But this is where things get messy. You cannot withdraw your earnings and your paper profits are just locked up. As we have said countless times, once emotions take over, it becomes very difficult to tell what's real from what's fake. But does that mean smart investors didn't notice this scam? The simple answer is no. When smart investors recognized it as a Ponzi scheme, the developers came back with a new strategy. Another marble game that required users to spend even more money to access their funds. But as with everything that has a beginning, there is always an end. By November 1st, 2021, the Squid Game token had rallied to nearly $3,000 before crashing all the way down to zero. The crash happened because the creators suddenly drained the project's liquidity, reportedly stealing about $3.3 million from investors. Within moments, the token became worthless. Just like that, one of the biggest rug pulls in crypto history was complete. The developers vanished, leaving investors with empty wallets and no trace of where their money went. So, what can you learn from this story? Do not chase FOMO. Always do your own research before investing. Remember this, if they are hyping it, it has already happened. If a lot of influencers are hyping a project, pause, think, and study the real reasons behind the hype. If there is no solid justification, walk away. Smart traders spend their time researching projects before investing, because without knowledge, the market becomes a casino, and your capital is what's at risk. Rug pulls usually follow a predictable cycle. FOMO first, social media hype next, and then the sudden rug pull. I know someone might ask, how do you protect yourself from pump and dump schemes and rug pulls? Start by doing your own research. Study the project, understand what it actually does, and research the team behind it. Are the developers public or anonymous? Has the project been audited? Is there a lock-in or vesting period, such as 1 or 2 years, that prevents early investors or developers from selling immediately? Also, remember this. In crypto, most rug pulls happen in the DeFi ecosystem, especially on decentralized exchanges. That's because anyone can easily create a token and list it on a DEX without paying listing fees or going through audits or strict checks, unlike centralized exchanges. That lack of oversight creates the perfect breeding ground for manipulation. Scammers take advantage of it by getting highly creative. They roll out bogus offers, make unrealistic promises, and even claim fake partnerships that either don't exist or never actually happened, all to lure in greedy or unsuspecting investors. So, what's the takeaway? Don't chase hype and don't rush decisions. Create a strategy and stick to it. Remember, the ultimate goal of a smart trader is to protect their capital. And to do that, discipline and patience are non-negotiable. Without them, emotions take over, and even the best strategies can fall apart. Take your time, follow your plan, and make decisions based on research, not impulse. And remember the golden rule, don't trade or invest what you cannot afford to lose. Remember, this video is not financial advice. It is only for educational purposes. Investing and trading are risky and can wipe out your portfolio if you don't know what you are doing. Always do your research before investing, and do not invest what you cannot afford to lose. If you found the video helpful, like, share, and subscribe. Thank you.